Every smartphone starts as an assembly problem. Raw materials are mined in Congo, microchips forged in Taiwan, glass engineered in the US, and assembled in China and India. A single device relies on a synchronized relay race spanning more than 40 countries. To run this network profitably, corporations adopted a strategy called just-in-time manufacturing. They stopped paying for huge warehouse storage. Instead, they ordered parts so they would arrive exactly when the assembly line needed them. It saved billions, relying on the assumption that global shipping would always function smoothly. In 2020, that assumption collapsed. Factories across Asia locked down, shutting off the supply of parts. At the exact same time, billions in stimulus checks flooded into the US economy, creating a massive surge in consumer demand for physical goods. The system couldn't handle the strain. Shipping companies cut capacity early in the year, leaving empty shipping containers piled up at American ports. When demand roared back, automakers who had canceled their semiconductor orders couldn't get back in line. Car frames sat idle on factory floors, completely finished except for a single 50-cent microchip. Shoppers felt the breakdown directly. You saw months-long waitlists for basic appliances, massive delays on dealership lots, and empty aisles at retail stores. The scarcity drove the price of goods sharply higher. Decades of prioritizing pure cost efficiency created a system where one break can freeze everything. Companies can no longer afford to prioritize cost above all else. They are rebuilding for survival. The most severe vulnerabilities in this network are geographic choke points. These are narrow, unavoidable physical corridors where massive percentages of global trade are concentrated into a single bottleneck. When a single ship wedged itself sideways across the Suez Canal in 2021, it trapped 12% of all global trade. That single traffic jam cost the global economy an estimated $9 billion every single day the waterway was blocked. Even when maritime routes stay open, the destination ports themselves act as choke points. At the height of the supply crisis, over 100 container ships were anchored off the coast of Los Angeles, waiting weeks just to secure an unloading dock. The highest risk bottleneck is political. Between 40 and 50% of the world's entire semiconductor production sits on the island of Taiwan. Every major electronic supply chain routes directly through this highly contested territory. Relying on these single points of failure is an unacceptable operational risk. To protect their ability to produce goods, major corporations are actively restructuring their manufacturing footprints to bypass these specific physical and political traps. This matrix outlines the decision framework operators use to relocate production. They weigh the capital cost of moving against the geopolitical security gained. The most aggressive option is reshoring. This pulls manufacturing out of foreign territory and rebuilds it entirely within the home country. The financial barrier to doing this is staggering. You have to pour billions into new capital expenditures just to build the physical factories, and then permanently absorb the premium cost of domestic labor. What you get is total operational control. Your goods never cross a volatile ocean corridor, and foreign adversaries cannot arbitrarily shut down your production lines. The U.S. government forced this shift through the CHIPS Act, deploying $280 billion to drag semiconductor fabrication back to American soil, financing massive Arizona plants. The second option on our matrix is nearshoring. Companies move production out of distant, hostile regions, but only as far as a border-sharing neighbor. For American companies, moving to Mexico eliminates ocean freight risk and drastically cuts down transit times. Managers can easily visit facilities, and the labor rates remain significantly lower than in the U.S. The compromise is localized risk. You trade maritime vulnerability for exposure to regional politics, currency swings, and local infrastructure limits, like the Mexican power grid. Reshoring guarantees your output, but demands immense upfront cash. Nearshoring limits your shipping delays, while requiring you to navigate a neighbor's domestic constraints. Next on the matrix is friendshoring. This keeps production overseas, but restricts contracts strictly to nations that are politically allied or highly trusted by the home country. This strategy preserves the economic benefit of cheaper foreign labor. It allows companies to keep their unit costs low while insulating themselves from surprise tariffs or sudden state-sponsored embargoes. Nations like India, Vietnam, and Poland are rapidly absorbing the manufacturing contracts that Western companies are pulling out of less cooperative territories. But the logistical hurdles remain. Your products still spend weeks crossing the ocean, and you have to rely on the developing ports and freight infrastructure of emerging markets. The final strategy on our matrix is the China plus one approach. Companies maintain their primary hub in China, but build a secondary, backup supply chain in another country. The Chinese manufacturing ecosystem is incredibly efficient and deeply established. Many companies recognize that totally abandoning it is impossible, so they build a duplicate network to act as a fail-safe insurance policy. The cost of that insurance is raw overhead. You pay to run two parallel supply networks simultaneously. Splitting your volume means permanently lowering profit margins. Maintaining cheap overseas production is still possible, but doing it securely means you deal with the friction of relocating to emerging nations or absorb the cost of running two factories to make one product. To figure out the right move, you have to look at the product itself. This chart plots implementation cost against geopolitical security. What a company manufactures dictates exactly where they land on this grid. For advanced technology critical to national defense, like semiconductors, extreme cost is no longer a deterrent. They are forced into the top right quadrant. Reshoring is a mandatory requirement. For bulky consumer goods, the sheer weight of ocean freight forces the issue. This pushes heavy automotive manufacturing directly into the nearshoring quadrant, moving production to adjacent borders to eliminate maritime shipping entirely. Moving an intricate, heavy assembly line is difficult. It takes years to establish the steel and component sourcing required to build a modern vehicle in a new location. Finally, labor-intensive products with lower margins, like apparel or consumer electronics, cannot survive domestic wage rates. They must stay in the lower-cost friendshoring or China plus one quadrants. No one gets a perfect supply chain anymore. Businesses must align their operational vulnerabilities with the margin profile of the specific goods they sell. For investors, the strategy is shifting. The opportunity is no longer in finding companies that squeeze the last penny of efficiency out of global networks. The capital is flowing toward the infrastructure required to rebuild these massive physical systems. There is immense demand for domestic logistics modernization, automation technologies that offset higher home country labor costs, and industrial real estate in the new manufacturing hubs of Mexico and India. Semiconductor equipment providers present a durable advantage. Instead of betting on which specific chipmaker wins the reshoring race, capital can target the companies that manufacture and sell the complex machinery every new fabrication plant is forced to buy. Ultimately, building a secure system requires more physical inputs than building a fragile one. Duplicating factories, raising wages, and over-ordering buffer inventory means more steel, more concrete, and more labor. That increased base cost is not temporary. When production becomes more expensive, those costs are permanently passed down to the buyer, embedding a higher baseline of structural inflation into the broader economy. The era of ultra-cheap, fragile globalization has ended. Companies are actively spending billions to buy resilience, and a permanently higher price tag is the cost of ensuring the shelves never go empty again.